Hi, I'm Chris McMahon. I'm a financial expert. For 40 years, I've helped people live their best financial lives. We're going to talk specifically about what I need to avoid in 2026. What do I need to avoid to live a better financial life? We're not going to buy things we don't understand. That's a common mistake people buy. Forget about the complexity, disregard it, buy it anyway, and then end up in a place or invest in it, end up in a place where they're very uncomfortable. Avoid expensive things. That's a good rule of thumb in life. Oftentimes in life, the better the thing is, the more expensive it is. That isn't always true in investing. So we're going to talk about that. We're going to talk about annuities and maybe why we should avoid those going into next year. There's certainly certain types of annuities. And we're going to talk about things like private equity, which is super complex, and maybe why, at least for a while, we should avoid this, or at least specific kinds of private equity deals. The president was talking about allowing private equity being in 401ks, which I understand, but it could be problematic. That didn't happen yet, thankfully, I think, because it's very complex, and we want to talk about that. If we avoid these four things, what we're hopeful for is that we're going to end up in a better financial position, living a better financial life, being more comfortable, and feeling like I'm more on track than I was before. Let's talk about that a little bit. Let's get into this a little bit. The first mistake of investing is never talk about investing. Now that's Fight Club. The first thing about investing is don't buy things I don't understand. Very unusual that people will buy things that they don't appreciate or understand in detail. But investments are weird. We have this kind of thing we carry around with us where we don't want to look silly, so we don't ask things. It's very important to say, I don't understand what that means or that acronym means. You know, I was talking with someone and they were talking about a CLAT, which is a charitable lead annuity trust, which is a very complex idea. And after the meeting, after they agreed with everything that was said in concept, they actually called me and said, I don't understand. They were suggesting that I buy a CAT, which is a CAT, which has nothing to do with it. My point is, we can't be embarrassed, and we can't certainly buy things we don't understand, because oftentimes complexity leads to frustration, it leads to confusion, and it leads almost always to illiquidity. What does that do? It derails our plan. So if you don't understand something, always ask, but it should be relatively straightforward. There's tremendous resources today on the internet. Tremendous. There's a lot of terrible things that happen with technology, but one of the great things is we can get into tremendous detail on what is available to us. And there's nothing, sometimes we get too sophisticated for our own good. We say, I understand mutual funds and I understand exchange traded funds, ETFs. Maybe a little less, but I think I understand them pretty well. And then the people will say, if I don't understand what this is, I'm still going to buy it because it was recommended to me. Very important that we say, I'm not going to buy anything until I fully understand it. And if someone is advising you to do it, it's important that we use a third party to go out and get resources. If it's the internet, if it's another advisor, if it's another professional we're calling upon, often our CPAs are an excellent resource for this, where they can come back to us and say, here's what this means. But I've never seen someone come back to us after decades of doing this and saying, boy, am I happy I bought that product I never understood. What they normally say is, I'm angry, I should have never done this, and I'm frustrated by it. Even if it's performed well, sometimes they'll say, I didn't understand the surrender period. I didn't understand the expenses related to it. I didn't understand what I was giving up when I bought this thing. So number one, don't buy things you don't understand. There's nothing wrong with getting to retirement or getting ready for the kids for college and saying, all I have is a few mutual funds and I have cash. There's nothing wrong with that if it's okay. Okay? Number two is expensive things. Some people have a tendency to believe if it's more expensive, then it is better. And nothing has been less true in the investment business over the last certainly 15 years. It's been a great time to be in the investment world simply because costs have come down so much. There's been so much aggregation of businesses. We see all the time on television, free trading with our investment account, no account fees, no expenses in our accounts. This is all relatively new. You know, in the old days, you would say there are three legs to an investment. There's the financial advisor, and that cost associated with the financial advisor might be up to 1 or 1.25%, depending on the financial advisor, the amount of money. There's the account fees and transaction costs. That used to be as much as 50%, half a point, what we call 50 basis points. And then, of course, there's the internal investment cost, which could be in a mutual fund, 1%. If you added those up 15 years ago, that could be as much as 3% annually. Well, that has an enormous expense over time. Today, with the advent of transparency, which is wonderful in technology, we can really do some online cost studies to really determine the value of where we are. That doesn't necessarily mean that paying more for an investment ultimately is less valuable. However, we need to look at net returns, net of all expenses. And really, in most of our investing, We're telling our folks that ask us, if with those investment fees, those internal expenses, which have come way, way down, and the transaction costs, which are almost non-existent, those three should be no more in our estimation in normal investments, normal mutual funds, normal exchange traded funds, 1.2 to 1.6%, give or take. If someone's doing a more complex deal, it may be a little bit higher. But I think in general, expenses are the enemy of a financial plan. Expenses in no way we want you to be concerned about expenses. We don't want the expense tail to wag the investment dog, but it's very, very important. Let at least be the leash on that dog for a few minutes, okay? Because more expensive doesn't normally correlate to better. It normally correlates to worse and a harder mountain to climb. And that leads right into our next thing, which is annuities. We have to be very cautious of annuities. It's very interesting when people will say, I have an IRA, a retirement account or whatever it is, and I've invested in an annuity. And you'll hear people talk very, very negatively about annuities. I never heard so many different and passionate things. There's a financial advisor who advertises, and I heard him say, I would rather die and go to hell than sell an annuity. And I thought, my goodness, that is an incredibly, absurd statement to make. But the point is, for that person, they believe annuities are always bad, always expensive, always difficult to get out of. I don't subscribe to that. I think there are situations, particularly now with annuities that are much more reasonably priced, don't have significant expenses, fees, and surrender charges. It goes back to what we were talking a few minutes ago. Some of these products, particularly annuities, someone might buy it not realizing I have 14 years till I can get my money out without expense charge. That's very important. Another big issue with annuities is they'll tell folks, well, don't worry, your annuity value is X. You say, oh, my goodness, I'm guaranteed to get my money back. But let's say you put that money in for 10 years and you put in $100,000 and 10 years goes by and I could go back and I could get my $100,000 today. But the insurance company says, nope, that's not how this works. Yes, the annuity value is $100,000, but you can only take it out over the next 15 years in systematic payments, thereby ensuring that they don't have to come up with that money. So annuities are complicated, expensive, confusing, not always terrible. I want to be clear about that. However, I think almost always we want to make sure that we don't have these extended periods of surrender charges. We want to make sure we don't falsely believe that we get all of our money back in a lump sum if that's not how the contract works. I think inside of an IRA, it almost never makes sense to have an annuity inside an IRA because remember, annuities grow tax deferred, which is wonderful, but the IRA itself is tax deferred. So there's no reason to take that on, I don't think. And lastly, we want to talk about private equity. This happens more and more as people get a little older, a little bit more sophisticated perhaps, or sometimes they're young and very aggressive. And they'll say, well, normal stocks and bonds and mutual funds and exchange traded funds just aren't complicated enough for me. I have a friend who's opening a series of restaurants and I want to invest in those. So those are private placement, private equity deals. Very, very difficult to make money in those over the long haul. Very difficult. It does happen sometimes, but we also see the opposite happen. Somebody puts money into a deal, they entrust in somebody, they have 5% of the business. What happens? The business, the failure rate, I'm all for entrepreneurism, but the failure rate is just so high. The president was talking last year about allowing us to add private equity to our retirement accounts. That wouldn't be these kind of small deals. That would be these large institutions that do private equity. Private equity does have place in some people's financial plans, but I would suggest to you, if we're going to add any private equity into our financial plans, we'd want to be what's called a qualified investor, meaning we have over $1 million of investable assets, and we also have knowledge that we could lose that money. We have to put it in there knowing that we could possibly lose it, much more so than publicly traded securities. And I think also we have to make sure that we really comprehend how long it takes to get the money back. Remember, for all of us that have a little bit of money in our mutual fund or a bank account, we're used to saying in a bank account, give me my money today. In a mutual fund, sell it and give me my money tomorrow. That's normally the way it works. With these private equity deals, you have to look at them because even the large ones, the large kind of Wall Street, private equity kings, it takes a period of time to get those assets back. Sometimes it's up to 2 years to get those monies back. So they're very liquid. They're much more aggressive. And we have to be very, very careful. I think in general, if we're building our financial plan, we should try to avoid private equity. And if they come online in our retirement accounts, let's take a hard look at that. So I think, again, as we look at the 5 things we want to avoid things I don't understand. Number 1, that's probably paramount. Don't buy stuff you don't understand. Don't be afraid to ask questions. If we don't understand, say, I just simply don't understand this product, therefore I'm uncomfortable buying it, which is very important. We don't want to buy expensive things. Let's not equate in any way value with cost. they're completely disconnected in the investment world. We want to really take a long, hard look before we buy an annuity and look at every other option and spreadsheet that, because a lot of times annuities are sold, they're not purchased. That is the case because it's an insurance product. So I would say to you, let's be cautious about that. Let's move slowly if we're going to do it. And I think when it comes to private equity, let's go into that in low gear at best. If we're going to do it, we got to check a lot of other bases first. So I think if we really, for 2026, avoid these four potential pitfalls, we're going to live a much, much better 2026 and beyond. It's going to help us get to our goals. It's going to help us retire comfortably. And it's going to help us be better stewards of the money that we've both earned and been blessed with. I'm Chris McMahon from Aquinas Wealth Advisors. Please click and subscribe below if you want to see more content about how to live your best financial life.